Hello and welcome to the weekly wrap-up here on Market Briefing. I'm Martin Baccardax, European business editor here at the IB Times UK. We're going to start right here in the UK with the banking sector, probably the most significant data point of the equity markets this week. The state-owned lenders RBS and Lloyds delivered full-year earnings, and both were disappointing in their own unique way. Lloyds today told us they unveiled a £750 million statutory loss that was wider than anticipated. It means the bank hasn't made any money for 3 calendar years. And a lot of the reason this year was linked to money the bank has to set aside to compensate customers who were either missold payment protection insurance or interest rate swap agreements with respect to smaller businesses. That set aside about 1.9 billion sterling, and as a result, the bank remained in the red, as I say, for the third consecutive year. The shares took a pummeling on the markets today. They were down 8.5% at one stage, and it's interesting because inside of that, there was a suspicion maybe that the bank was looking for ways for which the government could exit at least a portion of its 39% stake. Now that is if the shares get to about 61 pence each. At the moment, they're trading around 50 pence. It's a long way, it seems, until the government is prepared to get out of at least one of the banks. Now, the other bank that the government is involved in, and even more significantly, is RBS. UK taxpayer owns about 82% of what was at one stage Europe's biggest lender. That, of course, is the case no more. It's being wound down almost to the ground. In the case, it's going to be effectively a UK-focused retail enterprise. But nonetheless, it unveiled earnings earlier this week. Losses again for the 6th consecutive year, and that hammered shares as well. They were down about 7 or 8% over the past 2 days, and an exit plan for the government looks a long way away indeed. Now, the government has other problems as well it needs to grapple with, particularly the moribund state of the economy. The second largest in Europe probably is going to slip back into triple-dip recession in the first quarter of this year if some of the early data points are any indication. Today, manufacturing data suggested that very much so, and we're seeing similar hints of that through retail sales and some other mechanics. Now, against that backdrop, we had an interesting dynamic earlier this week when Paul Tucker, the Deputy Governor of the Bank of England, gave testimony to UK lawmakers about the state of the nation's finances. He did his best to suggest that he wasn't talking down the pound, but he didn't really do a great deal of, he didn't do it terribly successfully if that was indeed the aim, because the pound now is at about a 2.5-year low against the US dollar. That's probably excellent news for UK exporters and excellent news with respect to trying to get the economy back on track, but it does suggest even more imported inflation as Britons pay more for goods that they aren't able to buy domestically. Now, that doesn't bode well for inflation as a whole, and as a result, it does give further evidence to the assumption that the Bank of England isn't really that concerned about how fast inflation gets as long as some of their extraordinary measures can start to stoke growth. But at the moment, that growth does appear elusive. It appears elusive in Italy as well, and it was a stark reminder of the political crisis and how deeply, or I should say, how necessary it is to solve that because of the depths of concern about the third largest economy in Europe, and that, of course, is Italy. Data today suggested that GDP sank 2.4% last year, so that's the third recession for Italy in the past 10 years. That's an extraordinary figure in and of itself, but the news was even grimmer. We're looking at 11.9% unemployment across Italy. That will be well above the EU average. And youth unemployment in Italy is at an abysmal 38%. It's absolutely astonishing and does reflect some of the backdrop for the protest vote that many people say was part of the reason that Beppe Grillo, the former comedian, was able to cause so much turmoil in this week's elections. Now, there has been no movement with respect to putting together a cohesive political plan that would get some kind of consensus and allow a prime minister to be named. I think investors are continuing to bet that we're going to have a second round of elections relatively soon, but the clock is ticking because the man who would actually have to allow that to happen resigns himself on the 15th of May. That seems like a long way away, but given the glacial pace of conversation between the parties, at least this week, probably not that long in the grander scheme of things. So we're going to keep an eye on that into next week as well. Next week is going to be fascinating on a whole number of fronts, several different earnings, but probably more important from an economic perspective, we will see interest rate decisions from both the Bank of England and the European Central Bank, and probably most of us will be interested to hear what the ECB has to say with respect to some of its extraordinary measures and the state of the European economy, and particularly what's happening in the president's home country, of course, of Italy, Mario Draghi being a native of that country. And we'll also see the always important and always pivotal jobs data out of the United States on Friday, non-farm payrolls for the month of February. That's it for us, and we will see you on Monday.